Recessions can catch everyone off guard, but it's looking like there's a good chance the next one won't. Economists and financial YouTubers alike have been predicting a recession for months, with the majority expecting it to begin sometime early this year. The big debate has instead centered around whether this decline will look like the Great Recession of '08 or will merely be a blip on people's radar. Regardless of where this financial fissure registers on the Richter scale, business leaders and investors are bucking up for a bumpy 2023. If the past is any indication of what to expect, usually when there is strong inflation and the Fed raises interest rates to combat it, a slowdown or recession follows. This is almost always the case. Gradual overheating that boils over into a meltdown. This tale has been told before. And now, one financial behemoth has weighed in on how they believe this story will play out and what investors should be considering. BlackRock, the renowned fund management and investment group, has just released its projections for financial markets for 2023. The organization, which is believed to handle a staggering $8 trillion in assets, anticipates a period of recession triggered by central bank policies aimed at curbing rising prices. No surprises there. However, this recession will be distinct from prior downturns, according to its 2023 Global Outlook study. According to the report, as central banks rush to control inflation, a recession is likely. As they see it, liberal monetary policies are not on the way to act as a buoy for risk assets, as has been the case with previous recessions. Because the economic harm caused by central banks' activities is still accumulating, BlackRock expects stocks to suffer far more than they already have. Ominously, these analysts predict that even with the recession on the way, we will still be living with relatively high inflation. The investment firm argues that this new economic reality calls for new approaches to dealing with the market. The old playbook of buying the dip won't work because there needs to be a constant reevaluation of how dynamic policies hurt the economy. As a consequence, the study concludes, we don't see conditions coming back that would support a bull market in both stocks and bonds like the one we had a decade ago. A new economic playbook is necessary in a world characterized by a supply-based economy and high levels of inflation. In the past, the corporation has also expressed its thoughts on Bitcoin and cryptocurrency firms. The CEO of BlackRock, Larry Fink, claimed that he expected most Bitcoin firms will fail after the demise of FTX, once one of the major cryptocurrency exchanges on the market. He does, however, understand the importance of blockchain technology as a vehicle for tokenizing securities as part of next-generation markets. The Fed is causing it this time. Paradoxically, the Fed is hurting the economy after rescuing it in the last two downturns. By lowering interest rates to zero, the central bank made it easier for people to borrow money. It also made the market more liquid by adding trillions of dollars worth of assets to its balance sheet. It is now unwinding that balance sheet, and interest rates have risen quickly from zero in March to a range of 4.25% to 4.5%. However, during the previous two recessions, policymakers did not have to worry about high inflation eating into consumer or corporate spending and seeping throughout the economy via the global supply chain and hikes in wages. Many Fed watchers expect further rate rises up to around 5.1% by early next year, and analysts believe it will keep such high rates in place to curb inflation. There is already evidence that the increase in interest rates is having an adverse effect on the housing market. November house sales were down 35% year over year, marking the 10th consecutive monthly fall. The 30-year mortgage rate has now touched 7%, and as recently as November, consumer inflation was still hovering at an eye-watering 7.1%. With GDP growth predicted to slow to zero and layoffs mounting, it's obvious that a recession is in the cards. Jay Powell can finally follow in his mentor's footsteps. The central bank predicts that unemployment will climb to 4.6% next year, up from 3.7% now. Who will be hit the hardest? High interest rates, political instability, and inflation are all potential outcomes of an economic downturn. Blue-collar employees have historically been the worst hurt by economic downturns. However, many expect white-collar employees will bear the brunt of any upcoming economic slump. This is due to the fact that white-collar positions are easier to replace or automate today than in the past. Making matters worse, the so-called Great Resignation compelled many businesses to increase their employment efforts. Many of these new recruits were white-collar workers. Unfortunately, in the race to recruit more personnel, numerous businesses ended up hiring more than they could sustain. As the economy deteriorates, these businesses have no choice but to cut costs, beginning with the new guy in the office. Here's a sample of the businesses that have already started a large-scale redundancy campaign. Meta fired 11,000 workers in November, the biggest workforce reduction for any employer in 2022. Booking.com laid off 25% of its staff, or 4,375 people. And Amazon has just announced that they will lay off 18,000 workers, accounting for 5% of the company's workforce. Is there anything promising on the horizon? Yes, even noted pessimist Michael Burry has discovered ways to invest his money amid the mother of all crashes. Burry's portfolio currently incorporates 60% real asset firms, a significant change from his earlier large investments in companies focused on digital platforms or IT. This might be his method of hedging against inflation by investing in firms that own assets, have infrastructure, and offer real-world services. In periods of inflation, keeping money for an extended period of time erodes its purchase value. Burry's inflation forecasts have prompted him to restructure his portfolio in the third quarter of 2022 rather than sit in cash for months or continuing to hold his big short positions. And according to veteran investor Jim Rogers, there is optimism on the horizon, but only for a limited time. We had a lot of pessimism because of inflation and other factors. Now it seems that inflation and pessimism are breaking, but keep in mind that this is probably the final surge. The 79-year-old investor understands how to make money in difficult times. In 1973, he co-founded the Quantum Fund with George Soros in the midst of a hairy bear market. Between then and 1980, Quantum Fund made a return of 4,200%, while the S&P 500 managed to grow 47%. Rogers, like Burry, is heavily invested in real assets. He's on the record saying, "I own commodities, and commodities certainly are going to do well because of supply constraints that are developing, and the central banks will print more money eventually because that is all they know to do. When we have a recession, they will panic and print more money, and when there is a lot of money printing, the main thing to own are real assets." As Rogers is also fond of pointing out, recessions are a normal part of the business cycle. Throughout history, from the ancient Egyptians to the dot-com bubble, there have been booms and busts. However, this does not imply that investors must accept that the stock market will crater in value and their investments will age like milk. Instead, investors must be proactive in their search for assets that can weather a recession with little damage to their bottom line. Having emergency funds is especially important when the economy is in a recession. Even though the job market is still pretty good, it could get worse, and losing a job is one of the main reasons why people should keep at least some cash on hand. If there's one thing that the financial markets always teach, it's that it's never a good idea to use what just happened to predict what will happen next. Tomorrow will bring different worries than today. Yes, things are bad right now, but that's usually when the next good time starts. That being said, here are your key takeaways for 2023 per analysis from BlackRock and super wealthy individuals like Michael Burry and Jim Rogers. 1. Plan for high inflation. 2. Brace for higher interest rates. 3. A secure job will be especially valuable. 4. You shouldn't bank on a dramatic recovery in the stock market. If you found this financial outlook useful, please let us know by hitting the like button. It only takes a second, but it really helps the channel grow. Thanks for watching. May you have a prosperous 2023.